Your money, their gain, who profits from Nigeria's economy? This is a story about banks, taxes, and your wallet. In the bustling financial hubs of Nigeria, amidst the glittering skyscrapers and the hum of countless transactions, a quiet revolution has taken place. It's a shift in power, a realignment of financial gravity that has largely gone unnoticed by the everyday Nigerian, yet it touches every aspect of their lives. In 2024, Nigeria's banking titans, those bastions of wealth and economic stability, became something more: the government's unwitting yet remarkably lucrative ATM. Last year, the Nigerian government extracted an unprecedented 987.4 billion naira in corporate income taxes from 10 of the nation's leading banks. This wasn't merely a significant sum, it represented more than a 100% increase over the tax revenue collected from the same sector in 2023, when banks paid about 440 billion naira in taxes. More astonishingly, this 987.4 billion dwarfed the dividends paid out to shareholders, which, while not precisely confirmed, are estimated to be lower than the tax take. For the first time in recent memory, the public coffers received a larger slice of the banking sector's profits than those who actually owned a piece of the banks themselves. This isn't a story of corporate malfeasance or illicit dealings. This is a story of economic forces, strategic policy shifts, and the undeniable financial prowess of a government grappling with fiscal challenges. It's a narrative woven into the very fabric of Nigeria's macroeconomic landscape, where rising inflation, a volatile exchange rate, and a central bank on a mission to stabilize the economy created an unexpected windfall for the state. The profit surge, a paradox of prosperity. The sheer scale of the bank's profitability in 2024 is breathtaking. Zenith Bank, for instance, reported a profit after tax, PATI, of 1.03 trillion naira, a 52.5% leap from 2023, solidifying its position as Nigeria's most profitable bank. Ecobank followed with a 179% increase in PAT, while other institutions like First Holdco, Fidelity Bank, and Wema Bank recorded over 100% growth in their PAT. Collectively, the 10 major banks under scrutiny, Access Holdings, FCMB, Fidelity, First Holdco, GTCO, Stanbic IBTC, UBA, Wema Bank, Zenith, and Sterling Financial Holdings, posted combined profits after tax estimated around 3.5 to 4 trillion naira. What drove this unprecedented surge in profits at a time when many other sectors of the Nigerian economy grappled with severe headwinds? A key factor was the Central Bank of Nigeria's, CBN, aggressive tightening of monetary policy throughout 2024. In response to soaring inflation, the CBN hiked the monetary policy rate, MPR, repeatedly, moving from 18.75% in January to 27.25% by year-end. This hawkish stance, while aimed at curbing inflation, significantly increased interest income for banks, allowing them to charge higher rates on loans and investments. The depreciation of the Naira also played a crucial role, as banks with significant foreign currency reserves or engagement in foreign exchange transactions saw substantial revaluation gains. The government's golden goose, a deeper dive into tax revenue. The 987.4 billion collected by the government wasn't a one-off anomaly. It was the culmination of various tax streams, including company income tax, CIT, and other levies. The increase of over 100% from 2023 speaks volumes about the enhanced efficiency of tax collection and potentially the impact of new or revised tax policies. For context, GTCO alone paid 175 billion 300 million naira to the government in taxes and related levies, a 205% increase from the prior year, exceeding its dividend payout to shareholders. Zenith Bank remitted 201.62 billion naira, reflecting a sharp 468% increase from 2023. First, Holdco also saw the government receive 58.66 billion naira, a 109% year-on-year increase. This growing reliance on the banking sector for government revenue underscores a critical shift in the nation's economic strategy. While oil revenue remains a significant contributor, the volatility of global oil prices and the drive for diversification have pushed the government to explore alternative, more stable sources of income. The banking sector, with its robust profitability and well-defined regulatory framework, has emerged as a prime target. Shareholder versus state, a reversal of fortunes. Historically, shareholders have been the primary beneficiaries of a company's success. Their investment fuels growth, and their dividends represent a direct return on that investment. However, in 2024, this traditional dynamic was upended within the Nigerian banking sector, with the government receiving nearly 1 trillion naira in taxes compared to estimated dividends below that figure. The state effectively became the largest shareholder, deriving more financial benefit from the bank's operations than the collective individual and institutional investors. While individual bank distributions varied, UBA, for instance, was one of the few where shareholders received more than the government. The overarching trend was undeniable. This raises important questions about value distribution, investment incentives, and the long-term implications for Nigeria's capital markets. Will this trend discourage potential investors if the government's share consistently outweighs that of traditional shareholders? Or will the increased government revenue lead to tangible improvements in public infrastructure and services, ultimately benefiting the economy and, by extension, the banking sector itself? The unfolding story, impact and implications. The implications of this unprecedented flow of funds from banks to the government are multifaceted. On one hand, it provides the government with crucial liquidity to fund its ambitious projects, reduce its reliance on borrowing, and address critical social and infrastructural needs. President Bola Ahmed Tinubu, for example, sought to introduce a windfall tax in 2024 on foreign exchange gains by banks, with the stated aim of funding capital infrastructure development, education, healthcare access, and public welfare initiatives. On the other hand, a sustained, aggressive taxation of the banking sector could have unintended consequences. It could constrain banks' ability to lend, invest in new technologies, or expand their operations, potentially stifling economic growth. It could also impact the attractiveness of Nigerian bank stocks to investors, both local and international, if the returns to shareholders are consistently overshadowed by government levies. The story of Nigeria's banks in 2024 is more than just numbers on a balance sheet. It's a testament to the resilience of the financial sector in a challenging economic climate and a powerful illustration of the government's evolving approach to revenue generation. As Nigeria continues its quest for economic stability and development, the relationship between its thriving banking sector and its fiscally demanding government will remain a critical narrative to watch, its twists and turns shaping the nation's destiny for years to come.